Let's move on and talk a little bit about the economy. So looking at the speed dials, again, the green, yellow, red, the stoplight, green is good, yellow is neutral, and red is negative. If we look at the very first speedometer for housing and mortgages, we see that's in the green. Things also were moving further into the positive range. If you can see the light bar versus the dark one in the green area there, the lighter shade is where it was before last month, and the darker is where it's at today. So now understanding that, if you look all the way across at all the different speedometers we've got here, disposable personal income is still in the red. However, it is moving towards yellow. It's moving in the right direction. Again, we need that stimulus package that we were talking about as a cover just because of the slow employment, getting people back to work. So there needs to be additional stimulus. Business outlook, which was red just a couple of months ago, has moved into the yellow and is moving even more positive. International economic outlook, that is improving. And corporate profit growth, like we said, we raised the GDP estimates, and you can see that in the bottom half of the chart here, where we've revised the Q3 and Q4 growth ranges to 15 to 25% in quarter three. So we expect exceptional growth coming here in the third quarter, and it to continue in the fourth quarter and come in somewhere between 7 to 12% annualized growth rate. Where does that put us on average for the end of the year? Well, we're going to end up negative. We're going to actually have a retraction in growth in 2020, even with the second half being very positive, just because of how far down we went in the second quarter, shutting down businesses literally across the United States. So we're estimating somewhere between 4 and 5.3% in the contraction for 2020. However, 2021, you can see we're expecting somewhere between 3.5 and 5.5% growth in the gross domestic product moving forward. So that is one of the reasons that the stock market is staying up, because it looks at the future and is trying to forecast the ability for companies to earn in the future, and that's being reflected in stock prices. Employment. Prolonged shutdowns contribute to slowing. So we saw some good growth in employment in May and June. We saw the increases there. You can see the green bars, but you can see it coming down in July and in August. Again, that's because some states literally had to close down a little bit, stop their reopening efforts. And actually in August, there's also about 238,000 jobs that were created just by hiring census workers. And so that's kind of a temporary thing. So that's got a caveat on the August job employment growth that took place. So we have recovered about 10.6 million out of the 22 million job losses, but we've still got a ways to go. Employment, while we said it's improving, it's been tempered by the rise in permanent job losses. What we're talking about here is at the peak, we lost about 18 million jobs. And even though the unemployment has dropped to 8.4% or 6.1 million jobs, the number of jobs that are not going to be returning, and we will have to create an economy that can create jobs moving forward to fill those lost jobs, those vacancies of people that are not going to be able to go back to work because those jobs are not coming back. Many of those are in small businesses because businesses are closing because of bankruptcies and just because of investment cuts across all businesses across the country. So the permanent job losses continue to mount, but I believe a couple months ago, we showed you an estimated somewhere around 4 to 4.5 million potential permanent job losses as a result of COVID. And we're at 4.1 right now. We talked about the global recovery is underway. And what this chart is showing, if you look at just the red bars represent 2020 forecast. So the total world output for GDP, which is the first bars, the red one is down about 4 to 5%. The US down about 7%. Europe is the worst, expectation being down around 9 or 10%, followed by Japan and emerging economies. The only country that we see positive, or region we see positive, is China. Could end up about 1% in their GDP for the total of 2020. Everybody else is going to have negative growth in 2020. However, in 2021, you see a big reversal. The green bars, you see the European areas coming back strong, getting up around 6 to 7%. China, which normal growth for China is between 6 and 8%, so they might be more normalized for 2021. And the other emerging markets in Asia, you can see a huge growth expectation there. What does that tell us from an investing standpoint? That we need to be looking at those economies and looking for opportunities. And that's one of the things we talked about up front, that their investment committee is considering, is where do we go to get some of that growth? If other areas, other traditional areas are slow or not growing as expected. A little bit on the market now. We showed this also in our mid-year review. What this graph is basically showing is that there were 6 large tech companies that were growing at a faster pace than the general economy. And that's represented by the green line in this chart. You can see literally from the beginning of 2015 through June of 2020 that those 6 high-tech companies, and they are Facebook, Alphabet, Netflix, Amazon, Microsoft, and Apple, all were outpacing the rest of the world, the rest of the United States, as far as growth within companies and sectors and regions. When you take the 6 companies out of the S&P, that is the gray line that you see, and you can see that the gray line outpaced the orange line, which is the international market. So the S&P still outpaced the international market, but it was much closer in line with the growth that was seen across the world, taking out those 6 companies. And why I brought this chart in is to talk a little bit about what's happened over the last week. Again, we showed you the PE ratios at an all-time high. We are even higher than we were just a couple of weeks ago. We're at 29.05 for the S&P, which is very, very high and in a overpriced range. And we've been talking about that. The market is overvalued. So based on that, what we did is break down the S&P in this chart, which is the light blue line, the one at the bottom, and then talked a little bit how that compares to companies that have been focused on the digital revolution. If you remember, we went from analog to digital many years ago, but we're still in that kind of digital revolution. Remember when you had an analog phone? Some of you can remember this, having an analog phone in your home and having to get a new phone because they switched the phone service to digital. That was the start of it. But what's going on now? We've got 5G coming, which is 10 times faster than the 4G service we have out there right now. We've got blockchain technology driving cryptocurrency, things like that. We've got a lot of things going on that are still driving this digital revolution. But what we did was we took those 6 companies out of that whole digital revolution sector and showed their growth, and that's this red line. And look at what happened since the market drop with COVID, the market crash. Since March, those companies, these speculative emerging technology companies, are like going gangbusters as far as their cumulative returns in the stock market. Another way to look at this is this chart shows the valuation measures. So if we start with the 3 bars on the very left, the red represents those 6 companies. The speculative emerging technology is the red. The blue is the digital revolution in general. And then the light blue, which you can barely see in this first group, represents the S&P. This is their enterprise value relative to sales. So you can see it's all relatively close. However, as we start looking into the second set of bars, which represents the earnings before income taxes, depreciation, and amortization of these companies, look how much higher the valuations of those companies are over the general digital or technology companies and the S&P in general. And if we go all the way to the right, now look at the price earnings ratio. This is the price you're paying for the stock versus its earnings. And look how much higher it is over the rest of the technology industry and the S&P in general. This is what we've been talking about, how the valuation of just a small group of companies is driving the market. And could that continue? Well, what's happened in the last week? We've seen a correction taking place in technology in the market. And I'm going to use Apple here for an example. When we look and just go back to August 7th, just the beginning of August to the end of August or September 1st, Apple stock went from $113 a share to $134. Now, I know there was a split in there and all this stuff. So this is the adjusted pricing based off of the new split values, okay? So $113 a share to $134 inside of 1 month. That's an 18.73% increase in the stock price. Yet, is there earnings potential there to support that? This is what we've been talking about, and this is what the money managers are worried about, is you want to be in the market, but you've got to watch valuations, and when they get out of whack, you have to make adjustments. Because look what happened in the last week and a half. Since the beginning of the month, Apple stock went down 15.92% to 112. Now, it went up 18.7, down 15.92, but look at the real dollar values. It actually closed on September 8th lower than it closed on August 7th. That's inside of 1 month, 6 weeks roughly. So this volatility, we believe, is going to continue because the market, when there's overvaluations, high valuations in there, corrections like this are going to come more often. And we're going to see this taking place. It's just going to be the nature of the markets as we move forward and as the economy is trying to get good footing under it. This should settle down a little bit in 2021, but we believe there's going to be a lot of volatility through the rest of the end of this year as we move forward.